Hey guys, welcome to Desk Corner 1. It's DECO again by this dull voice. This is our second episode on gold. In the last episode, we have went through the gold to silver ratio and how to properly use it, which most of the conventional ways may not be as reasonable as they might seem. If you haven't watched it yet, go check it out to enrich your knowledge on gold trading after this one. In this episode, we'd look into price movement of gold from a closely related, but rarely discussed angle. From 2018 till today, this indicator has an ultra-high correlation of -0.95 with gold price, and historically this indicator also had a strong negative correlation with gold price. That's why DECO thinks this could be the starting point for a valuation exercise, and it might give us a new angle to analyze gold as an asset for investment. Let's begin. When we talk about gold, what's your knowledge about it? Traditionally, even though gold standard no longer exists for nearly half a century, we still see gold as a quasi-money. That says, the price of gold is actually like an FX rate of the US dollar to 1 unit of gold. Besides, because gold is scarce in existence, and it cannot be massively produced, its value is considered very stable. And, naturally, gold becomes a safe haven asset. Let's take a look at this chart. It shows the monthly prices of gold, and two of the US's major stock indexes, the S&P 500 index, and the Nasdaq Composite Index, over the past 50 years. To make it easier for comparison, we have rebased the initial values to 100. What we can see here, in the long run, both gold price and the stock market have a rising trend. In addition, their value has increased substantially over the past 50 years. Until July 2020, gold price has increased by 51 times, the S&P 500 has increased by 32 times, and the Nasdaq has even made a 110-time increase. Many people know the legendary investor Warren Buffett has regarded gold as a terrible and unproductive investment for many years. His comment on gold has been very sharp, that gold gets dug out of the ground. Then we melt it down, dig another hole, bury it again and pay people to stand around guarding it. While what Buffett says is essentially factual, I think it is equally important to notice that no one's intelligence or wisdom can change the market force, and this chart has convicted a very strong message which is also a fact. In the age of fiat money, when central banks print money out of thin air according to their wish, the abuse of money printing has caused huge damage to purchasing power of money over time. Just think about this. Even for the most creative and productive companies in the world, we must keep reinvesting all the dividends in order to outperform gold, which just sits there and does nothing. This is also the very reason why you should not keep too much excessive cash for a long time, and investments in asset is the only way to protect your wealth. Gold is a safe haven asset. It's easy for people to think of another common safe haven asset, bonds. Or, precisely, government bonds or treasury. Treasuries issued by credit-worthy countries, those with AAA credit ratings, are considered as risk-free asset traditionally, meaning people think these assets are very safe, but there are distinct differences between bonds and gold. That says, bonds are contracts with maturity dates, and bonds pay interest to investors. To investors, if they buy a bond and hold it through its maturity date, the discount rate which equates the bought price and all future cash flow would be the yield. Since yield is equal to the rate of return to hold it through maturity, so bond yields are directly related to bond prices. When yield is high, bond price is low and vice versa. Alright, that's enough for the Finance 101. If we look into the historical data over the past 50 years, we can see that the US Treasury yield reached its peak in the early 1980s, and started to come down gradually. This downtrend has lasted for nearly 4 decades. I am using the 10-year Treasury yield here because yields for treasuries with shorter maturity have already fallen to zero. Since bond price and yield are inversely related, we can also conclude that bond price has been increasing over this period. The next question being, given a near zero yields, is bond still a safe haven at all? Let's take a closer look into relationship between Treasury yield and gold price. We'd realize that since 2018, the movement of gold price is almost the exact opposite of the Treasury yield. To express this in number, the correlation coefficient between the two from January 2018 till July 2020 is below -0.95. We know that the scale of correlation coefficient is ranged from 0 to 1, with the positive or negative side stating the direction of the relationship. It is rare to find such a strong relationship between two classes of assets. I can't help thinking, can we model the gold price movement from changes in Treasury yield? Therefore, I jumped into the longer history for clues. I start plotting the gold price and 10-year Treasury yield at the end of each month of the past 50 years on the chart. After putting together hundreds of data points, the result looks like this. Rather than being randomly distributed, These dots form a downward concave slope, which can be represented by this trend line. And there, I can also get the equation of this trend line in Excel, so we can make use of this equation to project a reasonable price for gold under a certain treasury yield level, all other factors being unchanged. Here's the result we have. To be honest, comparing with the actual gold price, this is not a perfect projection, but if we use the difference between the actual and projected gold price to assess whether gold is overvalued or undervalued over the past 50 years, it gives fairly reasonable signals no matter if gold is trading at severely undervalued or overvalued levels, if we use 30% derivation as the trigger point. For application in real life, we can see that gold had a robust rally since March after the Fed has cut its rate drastically. By the end of July this year, gold price and treasury yield was at this point. On one hand, theoretically, if gold price is at this level, the implied treasury yield is around 1.2%. Since the current yield is only at around 0.7%, we can consider this part as the margin of safety. On the other hand, if the interest rate stays at current level, the fair value of gold is around $2,800 per ounce. This is the potential upside. While I am only using the figure till end of July on this chart, the real-time data of 10-year treasury yield is easily available. One point to note, though, because the formula of trend line is taking treasury yield as the dependent variable, we have to rewrite the formula to make gold price as the dependent variable. With this, we can quickly make a reasonable guess. Yes, deep in the core of all financial model is guessing. There are some conventional ways to value gold. While many people just conveniently take metrics such as inflation rate, GDP or M to money supply, most of these methods do not only have a time lag, but the metrics themselves also can diverge from actual market situation. The method DECO employs has three major advantages over traditional valuation methods. First, this method is very simple and direct as there is only the formula, and 10-year treasury yield is the independent variable. Second, treasury is extremely liquid, and is being priced constantly by market force with minimum latency. Third, it reflects a seemingly exponential growth boosted by the extremely low interest rate, just like models we have for other financial assets. Of course, there are flaws in this method too. The most obvious being, when interest rate gets lower, especially when it tends to zero, the value would surge to extreme value. And the tiniest changes in interest rate could result in extreme volatility of the model's valuation results. Moreover, if the interest rate becomes negative, the model returns no number. Nevertheless, gold may be the most sought-after asset if interest rate drops below zero in the end. As we get closer to the next big debt crisis, we are already just one step away from negative interest rate. Another shortcoming of this model is that it's oversimplified. I didn't take into account other important factors like the relative strength of the US dollar, which is tracked by the dollar index, or even the gold-to-silver ratio. In history, when gold-to-silver ratio was at extremely low levels, it usually implies the market's confidence towards US dollar was low. Over the past 50 years, it has reached such level twice. The first time was in 1979 to 1980, when we had the second oil crisis, and the second time was after the GFC right in the middle of QE. You can build your own model based on DECO's treasury yield model. Feel free to discuss any thought that you can come up with in the comment section. Finally, given the current economic situation, the Fed has already stated that it could tolerate higher than target inflation for a period of time. This is a strong clue that the Fed doesn't want to hike interest rate even when inflation accelerates. Besides, raising interest rates would only make corporates hard to finance, which may in return trigger the next crisis, and may lead to collapse in credit. Therefore, the probability of a significant rate hike is very low. As such, stock is expensive. Bond is very expensive. And precious metal could be one of few asset classes that is relatively undervalued at this moment. No matter if you look at it from a valuation perspective, or a risk hedging perspective, in the year of 2020, gold would still be one of the most sensible choices for asset allocation, even when it is at historical high level. Of course, when it comes to investment decisions, there are always risks associated with them. DECO is sharing his view, but not any investment advice in any of his video. You should always consult a professional financial advisors for sophisticated investment advice. That's the end of today's sharing. If you like this video, smash the like button and subscribe to my channel, so you won't miss any unconventional market view by DECO. Thank you and see you next time.